Yeah, you do not need $1 million to do this. To get this $40,000 payment a year through an annuity with with inflation increasing adjustments like that, you don't need $1 million. And I did a video about this a couple years ago and the price has come down substantially. So let's just jump right into this. This is a $40,000 per year. I'm basing it on a 65-year-old male. Of course, it'll change with age, but getting $40,000 lifetime payment adjusted at 3% compounded annually. So that payment will go up by 3% annually. Let's take a look at it. And what is the initial cost? What do you think it costs? It doesn't cost $1 million. That's like the 4% rule where you have to put $1 million in to take 40,000 out and hope you don't run out by the time you're a certain age, right? It's supposed to last your whole life, but eventually it could run out, right? This one's never going to run out and it will keep paying you. So it's $693. $693,087.94 as of 2/10/26. That's the price to do this with the 3% COLA. So what's that going to give you? Oh, and to compare what it was in 12/10 of 24, it was 822,000. It had a little bit different, had a cash refund, so we'll give it a little bit on that, but that's a big difference. So you're talking 26 to 24, $129,000. Rates have gotten that much better, and we are still using super high quality carriers. So this one's going to pay you $3,333 per month starting in 1 month for the first year, and it will go up every year thereafter. There's the layout right there, right? These are the actual quote. Annual compounding is at 3% annually. So this is how that breaks down. As you see here, the first year says 333.34 at a 5.77. So 5.77, that's not like an interest rate or a rate of return. That's the amount of the total premium that you're taking out. So that's what in any other investment you'd need to be able to withdraw every year without ever running out of money, right? So here's your column with the going just up to age 95. Of course, it'll pay for life. 333, 343, 35, and so on and so forth. It keeps going up. And as you can see, the further you go, the higher it'll be, because this is the 3% COLA, cost of living adjustment. And we also have an installment refund. What does installment refund mean? Well, that means, hey, you're putting $693,087 and something happens in a week. You don't want that money going to the insurance company. So it will be paid to the beneficiary should anything happen until the full $693 is recovered. Now, there's ways to make gains on these in two. If you want to guarantee a gain, you can, instead of doing the installment refund, you put a 20-year period certain. And as you can see, the total amount of payments is now $1,074,000, right? So it costs you a little more. It costs you $733, right? It's $731, right? But you now guaranteed all that extra $300,000+ of beneficiary gain, right? So that's how that works. So you can put a 20-year. I just use the installment refund so we can use money back guarantee. And also the reason I did that is installment refunds available for all ages, and you can dial it in and it's money back guarantee. If you're 85 and you try to put a 20-year guarantee on it, it's going to be wickedly more expensive. So the longer the guarantee, the older you are, it gets more expensive. Anyway, yeah, there you go. There's your premium. There's the minimum guarantee payout when you do the 20-year. But back to what we're talking about. This is the installment refund. It gives a money back guarantee. So as you see in the very last term there, it ends at 4/10 of 2040. You get $4,591 because it's a combination. It's giving you the last payment and a little bit more to exactly equal the premium. So that's why that works that way. Great. So, and then if you live to age 85, the payment would be $1,147,000, but you got to live to that age because the minimum guarantee is actually at age, death benefit ends at 2040. So that's your 600,000, your 693 return. So that's going to be over in this column somewhere. 693 is going to be between the 14th and the 15th year is your term, your end of your guarantee period. You need to still be alive after that time to keep getting these payments. But should this person, I dealt with someone just yesterday that a 101-year-old client. Imagine if this client bought this SPIA at 50. Look at it, 95. That 3,000 is now 8,000. So these are longevity plays, right? Because you got 8,000 at a 14% payout now, right? And your cumulative is way over 200. So you can put 600,000 and live to 95. You get over 2 million back. So it's a longevity play. These are for super healthy people. I'm using A+ company. We'll get into that. $40,000 was, okay, this is what our breakdown. $40,000 annual payment starting in 1 month. Inflation protected at 3% compounded annually. inflation adjusted. It doesn't really protect you if inflation's at 15%, right? But it does well if inflation's at 1. Exclusion ratio, we didn't really get into that, but of that 33 or whatever payment is, 58.2% of it on that installment refund would be excluded from taxable income until you hit life expectancy and you have all your premium back, because it's a return. Non-qualified money is a return of principal and the interest they're giving you. If it's qualified money, it's all taxable, right? So it's not an issue. There's no exclusion ratio on that. But I like non-qualified for this for multiple reasons. With the new Secure Act, you have that 10% limit, 10-year limit, so stuff like that. And this is a highly rated carrier. When you're doing lifetime stuff, you want to use the highest rated carrier. You don't want problems in your peace of mind. It just makes common sense. So ever since I started in the business of, forever ago, for lifetime income, people always went towards the higher carriers. This one's A+ AM Best, A+ Standard & Poor's, at AA3 Moody's, a B Weiss, which is actually pretty strong, and a 94 Comdex, which makes them that only 6% of carriers are better. And they have a 16.7% surplus, where industry average is like 7. So you're talking, this is what I consider a strong company. You can feel more comfortable in the superior rating. With that surplus is huge. I'm really into surpluses right now, because, all claims must be paid by the carrier, and that surplus sure helps pay those claims. This is not available in New York. I don't do anything in New York. New York's just horrible. Cost in California, Colorado, Maine, Nevada, sometimes Texas, South Carolina, Wyoming. They have a premium tax, so it's going to cost you a little bit more. So you got to price it individually for those states. Anyway, yeah. So as you can see, we've had a huge, that's the end of my presentation. We've had a huge increase in the payout. The cost has gone down substantially to get that same $40,000 initial payment for that lifetime income. Now, what's cool is you can do these as a period certain. Just say, hey, do it for 20 years, do it for 30 years, and the age doesn't matter. But if you're 55, it's going to cost you more. If you're 75, it'll cost you a little less. So you got to call your agent for a quote on that. And if you're seriously interested, remember, this is for putting the money away. If you want liquidity, you don't want the $40,000. If you're more worried about liquidity, you're less worried about the $40,000 going away. This is a non-refundable, non-assignable, non-exchangeable. This thing can't be stolen, taken, anything, debt, anything. So it's super protected in the income side. So X, YouTube, LinkedIn for the most up-to-date information. Remember, no fees, just insurance guarantees. Everything I talked about, all built in. No surprises there. So, hey, everyone, thanks for watching. I hope you're all having a great week. Take care. Bye-bye.